The following is a presentation of TFNN.
All right, welcome everybody to today's Option Hour. My name is Don Kaufman, and I'm going to take you through the Option Hour, answering all your option-related questions. So again, to kind of get started here today, I hope everybody can hear me all right. I'm coming to you again kind of from the road once again. I've been on the road the last couple of weeks here during this show, and now I'm coming to you live from San Diego. Headed out to Chicago, though, later today, and it's going to be some brutal weather out there in Chicago. It's beautiful, though, here in San Diego. Anyway, definitely give me some good calls here today. I already see you guys kind of chatting in there. Yeah, that's what this show really is. So, again, my name is Don Kaufman. I'm with ThinkorSwim from TD Ameritrade. Now I am here for the Options Hour. We're going to talk you through a little bit about the markets to get going. From there, we're definitely going to talk about option strategies. And if you haven't listened to the show before, you can really call in regards to any option strategy you want. And I don't care if it's, futures, options on futures, stock, equity-related, index-related. If you want to talk about a couple of the ETFs out there, great. The really hot and in-play thing right now is talk about silver. I talked about silver a little bit last week. And silver being down today, and I'll talk about some of my positions there in silver, give you guys a couple of ideas along those lines. But, again, this is a call-in show, and I'm here to answer your questions. So give us a call, 877-927-6648. And week after week, I got to tell you guys, the calls just keep getting better and better. So, again, I kind of grew up around options trading. I've been around it now for years and years, and I've been with ThinkorSwim for the last 11 years, of course, acquired by TD Ameritrade. My day-to-day business, though, is I'm still on the software, still trading quite a lot, and here to answer your questions. So with that, let's give a quick recap of the marketplace, and then we'll take a couple of callers as we go along. Also, every single week as you guys tune into this show, I usually have some type of a topic specifically to discuss in regards to, something technology-related or just something like really trading-related. In the last couple of weeks, I've been talking about, utilizing different types of spreads, utilizing criteria. This week we're actually going to talk a little bit about what's called the market maker move and a little bit more about implied volatility. So, again, as I do get started here, feel free to call us because that's what this show is all about. Call us with your questions. And, the other reality is whenever you call this show, you can also just call in and say, hey, I'm looking at this particular stock. I'm looking at Apple. How do I get bullish? How do I get bearish? How do I get neutral on this? If you want to talk about just any of your positions that you already have on as well, or, again, if you're looking to put a position on a specific underlying and you're looking for different ideas surrounding that and possibly stocks, options, or futures, I'll try to give you some good ideas. So with that, give us a call, 877-927-6648. All right, markets today. Well, where have we been? ES Futures, and you guys know if you listen to the show week after week, of course, futures drive order flow for the marketplace. ES Futures, E-mini S&P 500 up 12. They've actually backed off a considerable amount here off the highs. Say a considerable amount. Listen, I'm a bear. I'm always going to be a bear. If they back off 4 points, I'm going to be cheering the entire way down. NASDAQ futures also, of course, off their highs. And the NASDAQ futures are a little bit more off their highs. They were up over 20 at one point today. Actually, they were up 22 at one point today. They've backed off a little bit here. Of course, bonds. Bonds is not a huge story today, but it will be later this week because our boy, Ben Bernanke, is going to be having, a press conference. Because we haven't heard a lot of them, enough. Anyway, so Ben Bernanke is actually going to have a press conference, which I have to be honest with you, I think is going to be a little bit of a non-event. That being said, every trader in the world, including myself, will be listening to that press conference, trying to read into it, and ultimately we'll see what comes out of it. Maybe he ends quantitative easing, number one, and number two. So this may be the end of QE2, which they have also stated, the Fed has already stated, will be kind of a non-event out there. Either way, I'm not sure how hard the E-mini S&P 500 or the entire market is going to be affected, but I will tell you, I'm going to be watching the bonds very closely, and I do have some directional positions here in regards to bonds. Other things here, of course, in play today. the VIX. The VIX is off very slightly today, but interestingly enough, the volatility index, again, the S&P 500 volatility index was up a full point yesterday. It was up 1 point when the markets were also up, which is kind of an interesting bias there. Typically, you look at the VIX. If the VIX is up, it's typically meaning the market's down. It's kind of a contrarian indicator, if you have it. And ultimately, the VIX was up with the market up, which a lot of us always look at, as contrarians as a little bit of a precursor possibly to a sell-off. We're not sure. We're watching really, really closely today for a possible intraday reversal. And again, we've seen markets a little bit off their highs today, and we feel NASDAQ obviously is being dragged down not only by Apple, and Apple is fading here on the day. They're starting to sell Apple a little bit, but of course Netflix, the big news out on Netflix. Netflix is the perfect, quintessential example of buy the rumor, sell the news. Everybody knows Netflix is doing spectacular, but the rumors are the growth might not continue, and of course this stock did nothing but an upside tear, and then ultimately after its earnings announcement, which were spectacular numbers, the stock's getting hammered by 20 points here today, which if you think about it percentage-wise isn't all that massive, but it's exciting. Why? Because I grew up in a bearish world, and I'm in a bear right now. So with that, give us a call. And we're going to give you guys a little bit more of a recap here as we go along. We've got some callers waiting right now, but give us a call at 877-927-6648. The other thing that is in play and all over everybody's screen today, of course, is silver. And I was talking about this yesterday when I do that little 5-minute talk every Monday evening with Tom O'Brien. Something definitely has caught my eye time and time again, of course, is silver and is the metals in general. And you can see silver having one of its first down days in many, many days. We'll take just a quick look over here at the silver chart. This is a ridiculous move to the upside, and you really saw volume just absolutely exploding yesterday. And I'll tell you guys a little bit as the show goes on about my position here in silver. So I've definitely got a stake in silver, and it's definitely a short position. So we'll kind of discuss that as we go along here. But silver's really been in play, and I feel like every time I turn on the TV, every ad I open up, I hop on to TFNN. Everything right now is advertising gold, is advertising silver. Buy gold from us, or we'll buy gold from you. And it's just really reminiscent of bubbles of the past. And that is in 2005, every time you turned on, it was like condo.com, come buy a condo in 2005 and 2004. Real estate agencies were promoting stuff absolutely massively. If you go back to 99 and 2000, basically everybody in the world was talking about some different tech stock, and it feels the same way right now when it comes to these metals. I turn on the TV, and the first thing I see on CNN this morning is an ad for gold, and I'm like, oh, I'm a huge seller, absolutely huge seller. And I think that silver and most of these metals are just way overblown, and you know what? I'm willing to put some risk into that trade. So with that, let me take the first caller, and again, give us a call at 877-927-6648. The first caller is David. David, are you there? Oh, I'm not sure if we're going to be on with our first caller here. Just kind of reading in here. Okay. Oh, all right. So this is just a question, that came into to TFNN. So apparently we don't have that many callers waiting in line over here. So I'm actually going to read. I'll read the question out aloud here, and then and kind of talk to you guys a little bit about it. So, I'm also reading some email questions as they come in. So, hey, apparently nobody's calling, so you need to get on the phone. Give us a call, 877-927-6648. And the question is, David asks, is there any set of parameters that you would, on just side of a trade with options, that you would, one side of trade options, low VIX, low implied volatility, so basically what the question is asking, and I apologize, it's worded a little bit strangely here as I'm reading this particular question, it's basically saying volatility right now is relatively low, okay? And with volatility so low, what kind of an option strategy would you necessarily utilize? And there is a difference in option strategies and how they are actually affected by volatility, and more specifically implied volatility. Okay, so with that, the answer is absolutely. Now, if you're kind of new to option trading, there's a premise that we've got to get through. There's really only two primary complex option strategies, and that is simple. Okay? When I say complex option strategies, that's an option strategy with more than one leg. Okay? Meaning I'm not just buying a call or buying a put or selling a call, selling a put. I'm actually utilizing a complex strategy such as a vertical spread or a calendar spread. And in the end, okay, you can right-click on our software, in the trade tab and pull up, and there's verticals and back ratios and calendars and double diagonals and deep and wide 4-month, 4-strike double diagonal, straddle, strangle swaps. I mean, there's just ridiculous number of different strategies in here. And ultimately, what it all comes down to, forget about all the complexity of options. These all strategies are vertical spreads and calendar spreads, and that's it. I mean, they're just calls and puts. They're vertical spreads and calendar spreads, and no matter how complex your strategy, like an iron condor is just two vertical spreads. Okay, a diagonal is a vertical spread mixed with a calendar spread. A double diagonal is, twice the commissions, right? So the reality, though, is it's all the exact same stuff. And ultimately, an easy way to position this is vertical spreads make us relatively short volatility. Calendar spreads make you net long volatility. So if you were a believer right now that you feel the markets are going to sell off and they're going to sell off hard, okay, something you might want to look at is buying out-of-the-money put calendars. Okay, so for example, I'm out here in June. I right-click over here on our software in ThinkorSwim, and I'm looking at a June 129 put calendar. And I'm simply going to pull it up, and that is going to be a June. In this case, we're going to make it September. It's a multiple-month calendar spread. And what does that really do for us? Well, this particular trade makes us, first of all, makes us positive theta. That is, all things being equal, this trade profits from decay of time. Why? The June option is going to decay at a more rapid rate than the September option. I am, in this particular case, in this calendar spread, I'm selling June, I'm buying September. The June option, again, is going to decay at a more rapid rate than September. All right? Now, the real key to this trade isn't the time decay just being in our favor. The key to this trade, in any calendar spread, is that the September option has more sensitivity to changes in implied volatility. That is, the September option has significantly more Vega exposure than does the June option. And I'm just going to kind of give you guys an indication of this by pulling up, what is called Vega. And Vega is an option's sensitivity to changes in implied volatility. And if you look at a June option, the June 129 puts right now have approximately 16 cents of Vega. What that really entails, that entails if there is a 1-point move in volatility, all right, now the volatility is currently sitting at almost 17%. If the volatility moves up to 18% or down, of course, to about 15 or 16%, a 1-point move in volatility is going to change this particular option, the 129 puts, by approximately 16 cents. That's how much effect volatility has on the June option. Well, 16 cents isn't huge, but you have to realize, a few weeks back when there was the crisis in Japan, the volatility spiked. In fact, the VIX went all the way at one point from 21 into the 30 handle literally overnight. So you had a 9-point move in volatility. 9-point move with 16 cents effect, is quite large. Now, let's take a look at the September options. If you take a look at the September options over here, there is considerably more volatility risk. September options have basically 31 cents of vol risk, meaning that options dated further into the future have more sensitivity to changes in implied volatility than do front-month options. So if you were to sell June options and buy September options, it makes you net long volatility. Ultimately, if the market sells off, volatility expands quite dramatically, and this trade can be really profitable from getting long vol. And that's just, in regards to the question that kind of came in, and there's nothing wrong with that. But again, if you believe the market was going to sell off hard, one of the best positions that you could actually put on is an out-of-the-money or several out-of-the-money put calendars on there. All right, so with that, let's take some calls. I mean, I don't see any calls in the queue right now, so give us a call at 877-927-6648. You know what? And feel free to call in and follow up about some of these calendar spreads here. Again, this is a call-in show. Man, Last week I had so many callers we did not know what to do, but this week it's a little slower here. So with that, let's we'll go ahead and take our first caller here of the day. Looks like Chris from Spokane. Question about silver. You there, Chris?
Yeah. I've got a June 11 43 call, and saw silver top out of that nice 47-degree mark. Was it yesterday? Gap down today. Was wondering what you thought of the possibility of it getting back into the 46.50, 47-degree range. I'm currently, just under 20% up right now, but thinking, do I hold and see if it'll move back? Just a little insight on that.
All right. So you've got a June, and I'm guessing that you're in SLV.
Correct, SLV.
Okay. So I just wanted to confirm. There's a lot of different ways to trade this silver product, and I'm sure there's more coming out by the day. Ultimately, you still bullish in here?
I'm sorry, say again?
I said, ultimately, are you still bullish on silver?
No, I'm thinking it'll top. I was thinking that it might get to 48, hit 47, and I'm speculative if it's going to get back into that range. I am actually looking for silver to do a reversal. I'm just wondering if it's ended its parabolic move right now, or what do you think?
I mean, I got to tell you, from where I sit and from my own positions, I'm short silver right now, and I got to be. I mean, I'm a big time contrarian. Some of the things that I look at are number one, the exhaustive buying. Look, I mean, if you take a look at the volume yesterday, it was ridiculous amounts of volume, and just in SLV, we saw almost 200 million shares trade yesterday. And at some point, that could be a function of short covering, and there's a lot of different variables behind that. But at some point, you got to realize that pressure is going to fade, and it's going to fade fast. And yesterday, it felt like the beginning of the end for silver. I can't say that we're not going to spike back up here short term, but it feels to me like the beginning of the end. And this product, I mean, this thing, there's no question in my mind, probabilities are simply tilted towards the downside here. I mean, if you looked at this particular product and the move that it's had, you have to agree that could it have more upside potential? Sure. Maybe it has 7, maybe 10% that it could possibly squeeze to the upside. Conversely, you got to look to the downside potential of this product. We could actually have somewhat of a 30 or even 50% down move in something like silver. So purely from like a probability type model, I like the risk-reward in that. I like the fact that I don't feel the product can squeeze more than about 10% higher, yet to the downside could have a 30 or even 50% down move. I'm definitely willing to have some degree of a position, a short position in that regard.
I agree. I agree that it's ready to go short.
The question is, what kind of a short position then?
Oh, all right. Well,
so,
I would.
What do you have on here? Just the call option? You're just holding it and waiting?
Well, I just have the call. Like I said, I was, at the close yesterday, it was up 63, gap down. Now I'm up 20. And was wondering, sort of if it would dead cat back into, the 46.50, 47-degree range. But no, I agree, is that I think that it is overbought. I think it's overextended. And I would probably just do the put. I'm fairly new into options trading, so I've just been doing puts and calls. I've been doing, pretty good with that, and listening, to your recommendations as far as some of the spreads. And I know that's what I'm going to be moving into, and I'm going to be paper trading spreads. But I'll probably just go with the straight put on SLV to capture the downside.
Sure. And so you're just starting out, but just keep trading small when you're just going to trade a put or just going to trade a call. And the reason I say just trade small is because, ultimately when you buy a put, all right, time is going against you, and you got to be right. And it scares me. And I know a put's 52 days from now if you buy it in June. You got all the time in the world. And I got to tell you, this is a wild product. And, I personally, I don't really like trading a lot of the metals. And I couldn't help myself with this because I work with Tom Sosnoff, on a daily basis, and he's one of the founders of ThinkorSwim, and he's just constantly like chirping about silver and how he's short silver, and it's just I can't take it anymore. So I finally put a position on just to quiet myself and him. But really, the reason I liked this position so much is the volatility in here. I haven't seen a metal trade at this vol in a really long time. I mean, silver is trading at a 50% volatility, which means the inverse, which is ZSL. ZSL is actually trading over 100% implied volatility in the front month options. It's just, it's exciting, you know, and I don't know. I'll trade any product that's got some action, but what's becoming even more exciting in, you know, these ultra shorts and obviously SLV in general is how much premium there is to sell. You know, it's right now, to me, the S&P 500 is kind of dead. I mean, we're meandering to the upside. It's not an exciting product to trade right now. So I'm getting that from silver here in this trade. But no, you know, I agree with what you just mentioned about you know, possibly rolling over your short position. And I don't know, have you looked at futures yet and futures trading at all?
No, I haven't. I think the next one I'm going to possibly venture into is Forex, but no, I haven't explored futures. And what little I know is, you know, I guess if you're caught at expiration, you're actually taking delivery of the product.
Well, yeah, I mean, I've always heard that before, like, hey, there's going to be an oil tanker in front of your house tomorrow. I've never seen that, though. But you know what, with futures, the only reason I mention it is I'm not a huge advocate necessarily of trading the futures. I do trade a lot of futures myself. They're not right for a lot of people because futures have monstrous leverage. By the way, the only product that's got more leverage than these futures products is, of course, Forex, and that's, you know, that could be a very scary business out there. But ultimately, the reason I mention the futures here in regards to silver is if you have ThinkorSwim, you can type in /SI, and it pulls up a silver futures contract. And the reason I was mentioning it is because SLV obviously doesn't trade heavily after hours, but the silver, the actual future contract does. And if you looked at it on Sunday night, it was up huge on Sunday night. At one point, it was up $2.79. I glanced up again; it was up like $3. And I'm short silver, and I'm like, you know, it was late on Sunday night. Like I couldn't.
You didn't sleep till Monday.
Sunday night. It was great. It was great. So I wake up on Monday morning. Silver's up huge, and just I literally glanced away again from the screen, glanced back. Silver's down like $1 on the day. So it's just, you know, it's just been really interesting trading surrounding silver, and it may have finally, you know, kind of broken its back of that upside move. Anyway, it's the first, at least, weakness that we've seen at this point. So good luck in the trading, and you know what? Get into some of those spreads out there. I think that they're going to help you, really going to help you huge here in the future.
All right, excellent.
Yeah, good talking to you. Thanks a lot for calling in, Chris. So, again, you know, if you guys are sitting at home, you know, options are definitely a learning curve. There's no question to it. So as you guys start to trade them, everybody starts with calls, everybody starts with puts. You got to mature beyond that in a relatively quick fashion. And the reason is you're going to have what we call a little bit of attrition of your account as you start to learn options. And spreads are in your best interest. Your defined risk, you know, you keep yourself intact. You know, I can make this much, lose this much, or somewhere in between. I believe it's an easier, gentler place to be when learning this business. So with that, hey, you need to give us a call. If you've got questions regards to really any products out there, give us a call at 877-927-6648, and we'll answer your questions live here. So with that, okay, taking a look at a few other products that we are interested in. Silver seems to be, again, kind of the talk of the town right now. Hey, nothing wrong with that whatsoever. It's kind of like in play, the hot topic. But as I was mentioning on silver is that, you know, with this product right now, take a look how high the implied volatility is. It's just, you know, it's just unusual to see a major metal with this kind of implied volatility. And take a look at gold for a second. So gold was obviously the talk of everything here recently. And you take a look at the implied volatility on gold, and it's like, all right, it's not that bad. It's about the same as the S&P 500. Obviously, it's about 16, 17%. And then you bring up, like, some of the double inverses, well, like, all right, so the ZSL, and you're looking at 100% implied volatility. And that, when you have 100% implied volatility, it really opens up the door to a lot of unique option strategies. I mean, the reality is when somebody says you have 100% implied volatility, like I'll open up the May options here, 100% implied volatility, what does that really saying for this particular product, okay? I mean, what does that denote? And that's kind of what I want to talk about. And I love this. Somebody actually chimed in here in the chat, says, love it when stock people trade commodities. I trade stocks, options, futures. I'll trade any product out there. But 100% implied volatility becomes very unique in the fact that, number one, this is a commodity product, okay? So what does that really mean? It means that commodity products typically don't go to what level? All right, you don't see commodity products trade to zero. Like right now, a barrel of oil. What's a barrel of oil trading for? It's trading for $112. If you saw oil trading for $10 a barrel, at some point, that $10 a barrel, it's like it's trading at zero. And by the way, I would pray that oil would trade $10 a barrel right now. Number one, I'm short oil. Number two, I'm long a car that eats a hell of a lot of it. So ultimately, commodity products don't necessarily trade to zero. But what becomes interesting is when you see a $15 or $16 stock trading with 100% implied volatility, what that means is the stock is capable of either going to zero or almost doubling. And it's an interesting opportunity from a risk-reward perspective because we know it being a commodity product, it's not just going to trade purely to zero. So there is a floor put into a commodity. I'm not exactly sure where the floor is necessarily on silver. But ultimately, if silver right now, and we'll go back to SLV here really quick and make this explanation, if silver right now is trading for $44, maybe 20 is equivalent to silver being zero. Maybe $10 is equivalent to silver trading at zero, okay? So if silver trades at $10, that's almost like silver trading at zero. It's got a floor in place, all right? And at some point, all right, you have to realize that 100% implied volatility gives you really astronomical upside with not as much downside, especially when you're in a double inverse ETF like that ZSL. And I have to be, forthright with this. That is a complex idea that I just threw at you. Not only is silver a commodity, it is not, okay? It is not trade and does not trade, and the options do not trade like a regular equity product. I mean, this is nothing like an Apple. This is nothing like a Netflix. So don't perceive that, going from an Apple to a silver makes sense because it doesn't. There's inverted volatility skews here. There's a lot of different factors in play when you're looking at a commodity product, especially like an ETF, like an iShares and Silver Trust. A lot of things work inverse here. And as somebody just chatted in over here, tuition can be expensive. There's no question about it. It is a learning experience to trade some of these products over here. Myself, my learning experience in commodities was with oil. I mean, the truth of the matter is I had never really traded commodities until a couple of years ago. I traded oil. I didn't know anything about oil. And you know what I really didn't know about? I didn't know how big an oil futures contract was. So I went out and I wanted to get short oil, and we had just listed, this is a couple of years back, we listed oil on ThinkorSwim as an actual futures product you could trade. So I just went out. I didn't use paper trading and use any of that. I just sold 3 oil contracts short. And I remember looking at my net liquidity thinking, I am going to throw up now. And over my shoulder is Tom Sosnoff, and he's like, ooh, that has to hurt. And I was getting annihilated. By the way, I was short oil back when it was trading in the $140 range, and it shot all the way, I believe it was about I think I saw it all the way to $152 a barrel. It got really, really ugly there for a couple of days. But an oil future is an absolutely massive contract in terms of notional value. And the same is true, if you were to trade silver futures, oil futures out there. And to be honest, yeah, I'm short a little bit of oil again today. I just don't see that commodity like oil is going to sustain that $110, $115 level for very long, as, of course, it'll stagnate a little bit of the economy here. That being said, hey, it's a position. Could be wrong. I also want to reiterate something here, and we're going to take another caller in just a second, is that when I say I'm short oil, or if I say something like I'm short silver, I don't necessarily just go out and short the underlyings. I don't like that position. I will utilize some type of defined risk strategy with decent high probabilities, in essence, to initiate that short position. And I want to make that really clear because everybody's like, oh, that means you just get short, just sell a couple of contracts here. Do I ever take just short positions? The answer is absolutely do. But the reality is you can do things more effectively, like on silver. If I wanted to get short silver right now, I can sell, for instance, this 46-48 spread, utilize the high volatility, take advantage of it. Okay? So with that, give us a call, 877-927-6648, if you guys want to discuss this in a little bit more depth. I'm going to take another caller right now. On the line, I've got Ken from Colorado, Portfolio Greek Review. What do you got for us, Ken?
Hey, Don. When you're reviewing your overall portfolio for the Delta and the Greeks, like you have mentioned, I got three parts of the same question here.
Go ahead.
First, should stock and bond ETFs be viewed together or separately?
Okay, stock and bond ETFs. The answer is you could look at those, as one, and there's nothing wrong with that, because there is a pretty heavy relationship between. Or you have like TBT or TLT?
Hello, you
still there with me?
Yeah, I can barely hear you.
Oh, yeah, I'm having the same problem here. So everybody else can hear us, but we can't hear one another. I was saying, do you have TLT or TBT?
Not at the moment, but frequently TLT, yeah.
Okay, so there is a definitive relationship in portfolio Greeks between even S&P 500, TLT, TBT, but you're right in thinking that. So, if you're looking at your portfolio and trying to aggregate everything together, the odd man out sometime is TLT or TBT, and you could sub that into its own little category. And I do trade a lot of those, bond ETFs. I have tendency to kind of mix them in with everything else. But the thing is, the bond ETFs carry very little weight against the spiders. Basically, if you beta weight a couple thousand shares of like TBT or TLT, it doesn't equal very much in terms of spider terminology. So you do have to kind of watch the TBT or TLT position autonomously at times. That help out a little bit there?
Yeah, you're kind of saying you can look at it both ways, but it definitely pays to look at it separately on occasion.
Yeah, I'll tell you, the reality is in my own position, I look at it kind of beta-weighted with the rest of the portfolio, but my TBT, I actually have a position in TBT. My TBT position is of decent size, and that TBT position, to me, I always look at it on the side as well. And it's only because I tend to carry a larger TBT position. I've really been kind of bullish on interest rates, which means short bonds in quite a long time. I've been like this. I've had that stance for about 15 months right now, which interest rates will go up, and sooner or later they will go up, and we'll definitely see after the Fed speaks tomorrow.
And that leads to the next question, which is the same question about viewing. Do you view standard and inverse ETFs at the same time as regard to Delta and Greeks?
Absolutely. No question about it. I mean, the inverse ETFs can have inverse betas as well. So when I'm looking at my Greeks, if I go over to my monitor tab, and I don't know if you're looking at the screen show right now, on my Greeks right now, I've got things like QLD, and I've got a mix of different underlyings on here, and you can absolutely beta weight, one into the other out there. Double and inverse, triple ETFs are all fair game for beta weighting, and I don't see a problem whatsoever. There's a lot of people I know that trade, for instance, SDS, which is, of course, the inverse of the spider. It's the double inverse of the spider, and sure, go ahead. It'll beta weight out there perfectly. And you can see this QLD. The QLD is actually producing a 3 beta, which is basically it's 3 times, of course, the S&P 500. It's quite proficient also at doing just that. So no problem whatsoever though with beta weighting those. In fact, we can even add, for instance, in this position, you'll see if I put an SDS in here. Are you watching the screen show right now or no?
It still doesn't work on my end. I've called them twice about it, and it's always last week. It's always last week's show that's on the TFN TV.
Yeah. Oh, that's good. Well, on SDS right now, you can see what I just did is I just bought equivalent of 100 shares of SDS, which produced a negative delta when I beta weighted it to spiders. By the way, for those of you that are listening right now and you're like, I have no freaking idea what that man is talking about. I'm beta weighting things together. I'm turning the deltas of of Microsoft into spiders and deltas of 3M into spiders and GE into spiders. See, the reality is this. In the end, all delta is not created equal. 100 shares of Amazon doesn't equal 100 shares of GE, does not equal 500 shares of Microsoft. But what you can actually do on ThinkorSwim is you can click and beta weight things, and you can turn your entire portfolio into one aggregated product. And I'm aggregating things right now to, for instance, the spiders. Okay, so it turns my Amazon shares into equivalent shares of spiders. I mean, it's pretty out there, like, you know, if you think about it. But the entire position, instead of looking at each one of these positions autonomously, which is a pain. I mean, I got, 8 different positions in here. I look at all the positions as one, and I equate them to the S&P 500. I say, if this position were one big lump, it would be equivalent to 643 shares of spiders, which basically means if this position starts to move, if the spiders start to move, that is, up or down $1, I'm going to make her lose $640 for every $1 move in the spiders. And that is how most position managers really read the Greeks, is they read it from that 50,000-foot view. Okay? And by the way, for those of you that are kind of listening right now, in terms of the Greeks and stuff like that, if you're on ThinkorSwim, okay, and you're watching this or listening to this right now, there's a button that you can hit on ThinkorSwim. It's called Support Chat, all right? And unfortunately, I can't pull it up on my screen show right now. I apologize here. But under Support Chat, you can go to Seminars. You can kind of type in my last name over there. Apologize here. I'm just moving my screen around a little bit. Doesn't appear I'm going to be able to pull it up right now, but on that Support Chat, you can literally go under Seminars, type in my last name, and basically you can pull up all these different chats about the Greeks. There's so much, in terms of chats in the archives there, and so much education you guys can grab. We're constantly doing more and more education as well on the platform, almost on a daily basis. So keep that in mind. So Ken, you still there, or did you cut out on me? Nope, I think he's done. Anyway, all right. So, by the way, Ken, if you're out there and want to call back, feel free to call back. With that, looks like he dropped off over there. All right, these guys are chatting in with me right now. It's going to be a fun show throughout the day. So with that, guys, give us a call. The number here is 877-927-6648. We want to take your calls in regards to really anything options related. I've gone through quite a bit here about option Greeks, and I got to be honest, man, when I start getting into option Greeks and we're on a radio show, it gets painful. Probably a lot of people listening, they're just like, that's it, I'm done. I can't possibly listen to any more of that. But, when I'm looking at my portfolio on a day-to-day basis, I have tendency to manage a lot of my portfolio via the Greeks. I look at delta, gamma, theta. I mean, ultimately, what I really look at is how much theta I'm collecting. Me, I like to be positive theta. That means all things being equal. I like to, of course, positive theta is the daily whittling down of an option's value. It's completely and totally inescapable in that if you trade options, you have to make a decision. You're positive theta or you're negative theta. In this case, I'm positive theta. That means as time moves forward, this position will gain approximately $109 a day purely for time decay. I'm achieving that by selling out of the money spreads in this particular case. All right, so ultimately what theta is time decay. Okay, so positive theta means that as we pass through time, the time involved in options, of course, is decaying in your favor. And it's, again, not the most exciting thing to talk about, here on a radio show, but if you guys have questions in regards to the Greeks, what I'm always looking at is how much theta I'm bringing in versus how much directional risk I'm incurring. And it sounds like Ken is back. Ken, are you there?
Yeah, and so from what I can hear, you are including the standard and inverse ETFs in your portfolio view.
Absolutely.
Okay, so the last part of my question,
I'll use inverse ETFs, doesn't matter.
How do you choose what the beta weight
I commingle all my different positions in here. You know what, though? The reality is, listen, once in a while, if you've got a really big position, all right, and that position is just, it's in TBT, for instance, look at the position autonomously. There's nothing wrong with that whatsoever because it deserves specific attention. The reality is my biggest position, more often than not, happens to be in the S&P 500. I trade a lot of S&P 500 futures. I trade a lot of spider options out there. And the reason it makes sense for me to always beta weight to the spiders is I carry the largest position and position risk within the spider options themselves. But if I've got a decent-sized position in silver or TBT, I'm going to look at that position. I'm going to put eyes on it, specifically. As I'm talking here and as we're talking here, Ken, the market looks like to be fading a little bit more. Apple's actually down now about $3.50. Futures are actually holding up a little bit. NASDAQ futures have faded. They're only up about 10 right now. And everything else on the screen, again, Netflix is starting to get hammered a little bit more right now. So Netflix opened up, it was down about $11 this morning. Now it's down about 23 and change. It's starting to get interesting out there. So, Ken, was there a third portion to your question there?
Last point, any guidelines on what to choose to beta weight against?
Oh, beta weight against? It's really what your portfolio is purely in. So, again, I beta weight against S&P 500 spiders. And by the way, I do not use the SPX. I kind of don't like the SPX. I don't think I've made that too secretive on this show. The SPX is the S&P 500 index options. In fact, it's ironic that I mentioned the SPX and saying I don't like it. That is where most people met at ThinkorSwim, kind of when the firm was getting up and started, is most of the guys came from that SPX trading pit. And now none of us traded. And the reality is it's only listed. The SPX is single exchange listed. It's a Chicago Board Options Exchange product only. Whereas if you look at the spiders, there's 9 exchanges making markets on the spiders out there. The Qs, they're phenomenal. IWM, beautiful product. All of these are completely, totally fine. It depends. Whenever you're going to beta weight something, and again, beta weighting is taking one product and turning it into another, basically. Anytime you're going to beta weight something, make sure that your portfolio has a heavy, heavy correlation to whatever product that you're utilizing. Beta weighting is most effective when you're beta weighting one index versus another, meaning that I beta weight the spiders versus the Qs versus the IWM, which is the Russell iShares 2000. And on and on. When I start beta weighting some really strange, things out there, like if you have a stock called Joe's Tree Cutting Service, you probably don't want to take Joe's Tree Cutting Service and turn it into shares of the spiders. Probably doesn't make very much sense. The correlation is not as high. So, all right, Ken, I appreciate you calling back in for me there. I'm going to jump to another caller, and feel free to call back here anytime.
Thanks very much.
All right, thanks again. Well, jump right to another caller here. It's Mark. It looks like in L.A. You got a butterfly. Mark, are you there?
Yeah, I had a question. I talked to somebody about, I've been selling puts, but he says I ought to consider bullish butterflies. It's a little less capital intensive, and if the thing moves in the right direction that your put works.
So can I ask, first of all, what underlying? Every underlying or just in general?
Well, I've sold puts in RE and MCP, most of the high volatility things, JDS and a couple others.
Sure.
It is capital
I'll give you some insight to it. The insight is this. If you sell puts, I'm just going to ask you a general question. Feel free to answer it any way you want. When you're selling puts, are you trying to get long stock?
Not all the time.
Okay.
I'm just looking for that big SAP premium.
The first idea I'm going to give you here is that if you sell puts and sell them naked, make sure you want to get long stock. It's a great strategy to get long stock, but it scares me when people sell puts and without the intention of getting long stock, because the reality is one day in a high volatility stock, the reason those stocks have high volatility, is because they got a lot of risk in them. And one day you're going to get just absolutely hammered with some underlying. And maybe that day has already come for you. I mean, you know exactly what I'm talking about.
MCP almost, but yeah, I've been scared a few times.
Yeah, I mean, selling puts, sooner or later you're going to feel the fear, and that's not necessarily a good thing. But ultimately, if you don't want to get long stock and the volatility is sky high, sell a put spread. I love the idea. Buying call butterflies, I don't really like it that much. And the reality is, listen, a butterfly, it's more transaction costs. Imagine that. We're a brokerage firm telling you don't spend transaction costs. But the butterfly has a very, very narrow range of profitability. And because it has such a narrow range of profitability, you got to hit that sucker right on the head to be able to make money, and it's not going to happen to you that way. Okay, butterflies have a very low probability of success, but they're cheap. Why do you think they're so cheap? Because they have a low probability of success. Selling puts or selling put spreads, and for you it sounds like selling put spreads might be more ideal, okay? But selling puts and selling put spreads has a relatively high probability associated with it. okay? But it's also got a little bit more risk. But I got to be honest, listen, I like what you're doing, okay? I wouldn't change it. The only thing I would change up if I were you is I would use put spreads in the high volatility stocks that I don't want to own.
Interesting.
Yeah, selling naked puts sooner or later comes back to haunt you. Like, listen, I sell a ton of naked puts on a month-to-month basis, but I only sell those puts. Like, I actually sell naked puts in an IRA because I want to get long stocks. I say I sell a ton. I'm scattering them on a couple of different, products out there. Selling a naked put's the exact same thing as selling a covered call. I just don't want you to get caught in a crossfire situation, meaning like you sell a naked put in some high flyer, and all of a sudden the stock the next day opens at half the price. Man, I've seen it too many times. I mean, I've taken hundreds, possibly even thousands of emails over the last 11 years on ThinkorSwim clients that have been selling puts, and one day things turn around and it gets ugly. It gets ugly in a hurry.
No, I understand. I think one of the ThinkorSwimmers, Frankie Walsh, said that's like picking up nickels in front of a steamroller. Eventually, you're gonna.
Yeah.
Quick question, if you have time. I have one more question, if you have time. If you got another caller. When do you roll your calendar? When there's a week before expiration, or is
about
there
4 to 10 calendar days prior to expiration? So I always use a window to actually roll calendar spreads. Anytime I've got a calendar spread on, that 4 to 10 day window. And you'll see that also reiterated by guys like Frank Walsh. And Frank Walsh just happens, by the way, to write a newsletter for us, and he happens to be a friend that goes back many, many years. But all of us kind of agree on that. That's not my criteria per se, but we use a rolling window to try to keep the trading more consistent.
Right. Okay.
Yeah.
Thanks for your...
I got another caller.
Thanks for taking your lunch hour.
I'm going to let you go, and we'll take one more caller here for the day. But, Mark, I'll let you call back. Yeah, so thank you very much for calling in. We're going to actually jump to Bob from Washington. Got a question about the spiders? Go ahead, Bob.
I can barely hear you, Don. Yesterday you were talking about the SPYs, I think the call spread, maybe 135, 137, and you said to stay small, trade small. If it blows up on you, do you let it expire, or do you take it off like 4 days out?
All right, so you're asking a fantastic question. What I was talking about yesterday was the difference between buying spread, selling a spread. It was basically taking small incremental risk. And if a trade went against you, and by the way, for those of you that didn't listen yesterday, I did a chat specifically on ThinkorSwim, and that's really, I think, what Bob is referring to. And basically the trade was about trade small, stay small. And what it said is if you have $1 at risk, that's it. And in a vertical spread, it's defined risk. So if the trade does go against you, let it go. Okay, meaning that I'm not here to teach you guys to, hey, this is how you fix this trade, or hey, this is how you fix that trade. Because the reality is, fixing trades does one thing. Okay, it costs you more capital, and it puts more capital at risk. And there's no if, and, or but about that. Hey, sometimes fixing trades works. Sometimes it doesn't work. But the reality is, to fix trades, you have to put more capital at risk, and you got to pay more commissions. So why do that? Why not just trade small, stay small, and instead of trying to fix trades, go out there and put on new trades that work for you. Trade small enough that if a trade blows up in your face, let it go. Now, when I say let it go, close all trades about 4 days prior to expiration. Don't let things just ride off into the sunset and ride off right to expiration, because the reality is there's some danger in doing that. Okay, just close your positions again about 4 to 10 calendar days prior to expiration, and it's ideal. So win, lose, or draw. Okay, close out your trades, and I take my positions to what's called the graveyard. I'll take them if they're blowing up in my face. I'll take those positions to about 4 days before expiration and close them out. So it's it's kind of great to talk about that in theory, but when you're put in a position where the most you can possibly lose, if you put on a spread that risks $1 to make $1, the most you can lose in that spread is $1. All right, trade a number of contracts that you're willing to part with 100% of that money, and you'll be so much better off in that particular trade. That's all I was really trying to instill in some of our clients yesterday, is that basically put yourself in trades, okay, that logically not only work for you in terms of probabilities, okay, but logically every position at some point is both a winner and a loser. If you understand, what's called probability of expiring or probability of touching is, at some point your trade is profitable, at some point it's a loser. Now, the reality is using vertical spreads okay, is just like using a stop order, yet you don't get stopped out of the trade. Using a vertical spread holds you in a position, and it gives you enough time for the trade to work in your favor. And that's really kind of what I was getting at there, Bob. You still with me? Got any follow-up questions on that one?
No, that's great. Thanks, Don. Have a good day.
Yeah, no, thank you. So, and thanks to you, Mark and Bob, for calling us in here. You know, I get so adamant about stuff like that. It drives me insane, man. I see people using stop orders. One of the emails that no doubt probably drives me the most insane is I get emails every single day, and somebody says, how do I use a stop order on a spread? And I will literally email you back, do you feel it is necessary, okay, to further define your risk on an already defined risk trade? And that's what you have to ask yourself, okay? Why use a stop order on a spread? Why don't you just trade less contracts, okay? Because, 9 out of 10 times, it all comes down to you allocated too much money. That's why you're in trouble. So let's get to the root of the problem. The root of the problem is you traded too big. Trade small, stay small. Try to get a commission structure that allows that too. Commission structures are definitely in play if you want to be able to trade small and be effective that way. So with that, we got to start to wrap things up a little bit today. And hey, I apologize today. I've gone off on a couple of interesting rants throughout the day. But I get really fired up about things like vertical spread. So I did a chat yesterday on ThinkorSwim. I did like the Monday afternoon chat, and it was all about basically the simplicity of selling option premium, but then it's all about logic, okay? So what it actually boiled down to is you don't have to be right picking market direction to make money in this business. All right, and I'll actually give you a quick example and leave you with that. You go out, for instance, and sell a spread on the spiders. I'll open up the June options here really quick. And you sell an out-of-the-money vertical spread. For instance, I'm going to sell a 137, 138 spread for 40 cents. Realize that this trade, okay, has about a 65% probability of expiring in your favor. This is a bearish trade, but you don't necessarily have to be right. So with that, kind of wrapping things up here. Again, my name is Don Kaufman, ThinkorSwim from TD Ameritrade. Every Tuesday, join me for the Options Hour. Next week, I'm actually going to come to you guys live from the floor of the Chicago Board Options Exchange. I just happen to be there, and that's where I'm going to be doing the show from. So with that, thank you guys very much for joining us today. And again, hey, we'll be back the next couple of weeks here. Enjoy it, and give us a call. All right. Thanks, everybody, and bye-bye.